first and foremost, let's just make the correlation here between why this jobs report and the weaker than expected print matters for the Fed and why people should be caring about how this weaker than expected print could actually mean a good thing for rate cut potential.
Well, the Federal Reserve, Brad, first of all, thank you very much for having me on the show. Federal Reserve, over a period of a couple of years, took interest rates up pretty significantly in order to bring inflation down. And the Fed's last rate hike was July of last year. Inflation's been coming down nicely over the course of the last 18 months or so. But in the last 3 or 4 months, inflation seemingly bottomed and started to go back up again. The base effects, we were rolling off the low levels of inflation and replacing them with higher levels, based upon energy, electricity, housing, food, wages. And so the Federal Reserve was getting nervous that inflation was starting to go back up, and their next move might have to be to hike interest rates again, which is something they didn't want to do. And today's number was a significant Goldilocks number for them, because the wage inflation number, both month on month and year over year, you talked about the 3.9% increase year over year. The month on month number was only up 0.2%. That would annualize to about 2.4%. So the Federal Reserve is feeling pretty good about that, because that means that they don't have to take interest rates up, and potentially it brings the prospect of them beginning to cut interest rates back on the table. Our view is that the Fed may cut rates once or twice after the election. There are FOMC meetings on November 7th and December 18th. So if the data continues to improve along the lines of what we saw this morning, and inflation sort of is off the table, then we may see the Fed begin to cut interest rates at the very back end of the year.
And so all these things considered, this is just 1 month's print, one data point for the Fed to take into consideration. And of course, a host of data points within this one print. But all of these things considered, it is just one print. So how much of a trend are they looking for in future reports to come out perhaps weaker than expected like this one?
Brad, you hit the nail on the proverbial head here. That one aberrant month of data is a blip. 2 months are a fluke, but 3 months in a row, then maybe you've got a new trend here. And that's what the Fed's watching. If you look at the other data that we saw over the course of this week related to this morning's report, the ADP private payrolls that we saw earlier in the week, very strong. Initial weekly jobless claims that we saw yesterday, very strong, suggesting the labor market is growing very significantly. And then a couple of inflation indicators, the unit labor costs and the employment cost index that we saw at the beginning of the week, again, very strong, suggesting that wage inflation is continuing to spike. The numbers we saw this morning were very different than that, in a lot of ways inconsistent. So the Federal Reserve is looking at this morning's report and saying, hey, this is great news. But which report is right? Is it this morning's jobs report that's right? Or is it the ADP report or the claims report or the employment cost index or the unit labor costs? The short answer is none of us know. So the appropriate thing for the Federal Reserve to do, which is what they did Wednesday, is literally nothing. Let's just stop and wait and take a deep breath and wait for a couple more months of data to determine, is one set of data a blip, or is the other set of data right? And what is the prevailing trend through the economy? Short answer is we don't know the answer to that right now.
And then just lastly, let's put some equity strategy on this as well here, Phil. Is there anything from today's reading that should be triggering the market reaction that we're seeing right now, or repositioning that investors should start to consider if we see more prints like this?
Well, the market's responding very enthusiastically to the fact that this morning's soft wage data suggests that the prospect of a rate hike is off the table and the prospect of rate cuts are back on the table. That's all good news. The market's responding well. But again, go back to what we just talked about a minute ago. Is today's data the real trend, or were these other data points the real trend? We're not going to know that today. It may take another couple of weeks, another couple of months. So the fact of the matter is that we were expecting some increased volatility in the markets over the course of the second quarter, over the summer, based upon the push and pull of exactly how the Federal Reserve is going to act, given whatever the prevailing trend of the data is. So today's rally, it may be the right trend, it may be premature. So we would suggest that still maintaining sort of a cautious defensive position until we've got a better sense of directionally where's this data going, and what might the Fed's next policy response to be, that may be the more prudent course of action.